Hi, everyone. I hope everyone had a good coffee break. So my name's Pimfa. I've been with Street Asia for almost 4 years now. I cover everything in Asia private equity across primary and secondary markets in Asia. So in the past years, I've covered the secondary markets in Asia quite extensively. That's why I'm very excited that we're joined by 5 experts in secondaries who are all based in Asia, and we're going to talk all about secondaries in Asia today. So, when you think about the topic of secondaries, it's one of the hottest topics in private equity right now for sure. But when you think about Asia focused content or Asia focused secondaries, there's not much content that's out there. So, with that, I'm very excited to be introducing some of the panelists today. Would like to kick this off with a brief introduction of everyone here.
Sure. Hi, everyone. My name is Martin. I work for Honest Group. It's a global private markets manager, $185 billion in AUM. I head up our private equity business across Asia.
Hi, my name is Jonathan Lau. I lead Omo Capital, and we're a specialist investment company focused on tail-end LP positions with a global mandate. So we specialize in buying 10 to 25-year-old LP positions.
Hi, I'm Karen from Collar. We are a global secondary specialist. We invest everything from LP-led all the way to GP-led and structured solution. We are currently managing 50 billion plus AUM across private equity, private credit, as well across US dollar and RMB.
Good morning, everyone. I'm Frederic Azemad. I'm managing partner of TR Capital. We created TR Capital 18 years ago. So we've done secondaries in Asia for 18 years, and we focus on active secondaries, meaning portfolio, single asset of direct and CVs in the region, mostly China, India, Southeast Asia, and Japan.
Good morning, I'm Ben. I lead Evercore's private capital advisory team in the APAC region. Private capital advisory is the largest secondaries advisory group in the world. Last year, of the 226 billion in advised secondaries, both GP-led and LP-led, PCA advised on 125 billion of that, so well over half of last year's advised market.
Thank you, everyone. Very excited. So before we begin, I just wanted to get started with what has happened so far this year. So I think 2026 is a very remarkable year for secondaries in this world. So we started off the year with a major consolidation between EQT and Collar Capital, and that deal would give a massive access for EQT into secondaries. And similarly, KKR's purchase of Arctos, that's going to give them a big exposure to sports investing, GP solutions, and secondaries as well. Combination with Lazard and Campbell Legends in the advisory space also says a lot about how the market's doing, and we'll talk about all of it today. So before we go into what's happening right now, I wanted everyone to just have a look at some of the data last year in 2025. So 2025, as you can see, is a record year for global secondaries for sure. But when you have a look at Asia, Asia is still single-digit percentage across LP-led and also GP-led. So I wanted to go to Ben since the data points here are all from Evercore. Well, since APAC consists of such a small percentage of the world global secondaries volume, do you think there's a lot of growth opportunities ahead of us? Is there any way that this single-digit percentage could grow further?
I sure hope so. I thought this data looked familiar. Anyway, so I candidly, I left a 10-year partnership at Adam Street 3 months ago to join Evercore, specifically because I find what's going to happen here in APAC to be so exciting. So I spent the last 12 years helping LPs build out their primary book. I think Doug was saying earlier, most of Asian LP and GP assets were committed post-GFC. So if you think about the average American pension, just to make this up, they've been investing in private equity for 40 years. So they're like a middle-aged adult when it comes to their private equity program. They are active managers of those books and those assets, buying, selling. When you are a new LP, a new entrant into the market, and you start post GFC 2010, 2011, 2012, as the vast majority of Asia-based LPs have, you are in active allocation mode. You're thinking about buying, not selling. I don't know if you have the slide in there, Pimfa, but as those programs reach target allocation, there's a shift in your approach from active allocation to active management, right? So my program's maturing, I'm hitting my 7, 8, 9, 10% target allocation. It's now time to think about what's the next go forward portfolio look like. And that means more buying, of course, but also some selling. The other thing that I've noted is obviously, this is no secret, we're hitting maturity of these portfolios at a period of historically low DPI. And so that is exacerbating the need to think about active management of portfolios. So I'm super excited. I think, if APAC represents 10% of global PE, then those numbers, the 2%, the 3%, have a long way to grow.
Maybe just adding also on this one, what is quite interesting is this number is small also because there is a massive imbalance between demand and supply, and very specific to the region, right? So if you think about it, Asia is 50% of the GDP, 25 of the global PAUM, and then 2% of the secondary. And there are, I think, a few elements to take into consideration. The market was still early and small, and when it was really started to grow and having a size that was interesting enough, where larger funds were coming in, it was probably 17, 18, and then you had COVID. First you have Trump 1, then you have COVID, then you have Trump 2. So people remain focused on North America and EMEA, while in a natural environment, you have seen more players in the secondary market coming up in Asia, right? So that's what makes it very interesting in our view as of today. Going forward, you have today 2.2 trillion of NAV that in Asia that is more than 4 years old, right? If you think about the capital that is available to be able to provide liquidity against that, massive imbalance also. So not only, in our view, the growth is there, but also the opportunity itself. And I'll finish by one point. There was someone in the audience here I've been knowing for a while, who was just coming back from an AGM in the US. And he was saying, he was a global fund, just saying everyone talks about US, everyone talks about Europe, no one talks about Asia. I think this is great for all of us here, because at some point people will, but right now it's a very interesting time to invest.
So from my perspective, I think it's definitely echo what you said. I think it's a very interesting time for secondaries, right? If you look at it, 2024, $160 billion of secondary volume, and that was a record year. And now way past that, we're over $200 billion. And there are just a few key drives that will continue driving the secondary market, right? I think Ben talked about DPI, historical low. 2025 was actually better, right? But still, if you compare that to the peak, right? If you look at distributions as a percentage of global asset values, right? I think from a Bain report, 2025 we were at 16%. And if you compare it to the peak in 2015, 10 years back, that was about 30%. And the long-term average is around 20%. So the DPI pressure will continue to be there. And what we're going to be seeing as well, I think what you talked about earlier is younger LPs, especially in the region, move from allocation to a portfolio management, active portfolio management. You're going to see a lot more portfolio optimization, rebalancing. And these are two key drivers that will really fuel the secondary market. What we do feel will take some time to get up there would be the Asia content as part of overall secondary. So it's 3% today. That could probably inch up, right? But in a big growing market. So overall Asia content in the secondary market, I think you're going to see healthy growth. But whether or not how long that actually takes to get to that 10% is probably going to take a little bit more time still.
I think on the GP side as well, if you look at the historical fundraising cycle, I think around 2017 to 2020 is probably the peak of fundraising market in Asia. If we look at the amount of Asia managers who are able to raise funds in the last couple of years, last year was a 12 all-time low in the last 12 years. So if you're a manager, your funds are approaching sort of like a 5 to 8 year sort of horizon, coupled with difficult exit environment, low DPI. It's time to think about how do I optimize my existing portfolio so then I can sort of deliver the DPI that LPs are looking for. And instead of being a passive passenger waiting for the market to reopen or valuation to come up, I think more and more GPs are looking to explore secondary as a solution for the first time as well.
John, anything to add?
Yeah, so we focus on funds typically from 2012 and older. So we're actually buying a lot of funds that are fund ones, fund twos, even from Asia fund of funds. And yeah, so we're pretty excited because our market, we think in the next decade probably grows 10 times. And there's going to be, the market becomes more fragmented with more asset owners coming to market.
Very positive. So I wanted to move on to the present now that we've talked about the overall environment. So since the tension in the Middle East escalated earlier this year, the deals or the asset sale processes that I've been tracking in the primary market, they have slowed down quite significantly. I think a lot of investment bankers are still getting appointed for some sale processes, but a lot of auctions or sale processes are set to be launched maybe H2 this year and not so much in the first half of the year. So things that I'm seeing in the primary market is very different. The pace that things are going in the primary market is very different from secondaries. I think things in secondaries are at least moving at a very normal level. What are you seeing on the ground in terms of deal activity or the pace of the deals in secondaries after the war started recently this year?
So speaking not only for myself in Asia, but also our global teams based in New York and London, we have seen zero let up based off of this situation in Iran. We've had no, sorry to take a different view, but we've had no LP processes put on hold as a result of the war there. So that's one data point from a group that looks at basically half the market. We are seeing a number of clients asking about potentially selling their energy assets. It's somewhat of a conundrum for them. They see war and missiles flying, and that's a very volatile situation that would naturally make an investor say, maybe I'll wait and see. But that said, if you're holding energy assets, right now is probably the best time to sell from a pricing perspective, because the moment the Strait of Hormuz opens up and things start flowing again, prices will go down, not up. And so we've been advising clients that have been thinking about a potential sale of energy assets, because it's a much more limited market in terms of both sellers and buyers, the assets there, that we think now is a good time to enter the market. That said, a process that takes 3 to 4 months, you could see the market change during that time. So it's something to be aware of.
So anyone with energy asset in this room, please go to Evercore. Anyone would like to add about the current
I think
environment?
from our observations, I think talking to the various advisors, I think it's good to know that a lot of the processes or all the processes that you guys have not been on hold. But we do see, I think, a few processes being pushed out. I think the intention to sell is definitely there, right? So it's not people actually putting it on hold, but sellers more or less talking about just pushing it out by a quarter in terms of sales. But what we do expect is really the GP-led market to come back very strongly. I think it's been pretty strong. I think the DPI pressure is just going to increase because of the slowdown in the overall M&A market globally, and hence I think we're expecting a flood of deal flow over the second half of this year.
What we've seen on our side and across the region, China and India is more. Liberation Day last year was definitely a first kick, which was a good one. And the war is probably pushing a few people that were just on the edge of saying, okay, shall we sell or shouldn't we sell? To say, okay, too much uncertainty, so now we are engaging. Now, we are looking also at the deals in a different manner, right? Because there is also uncertainty on the raw material. So you need to do a bit more work on the underlying asset to see which scenario would play out and how it potentially will impact your asset. So this is where we'll see how it plays out, but there might be a bit more disconnect between price of the buyer and seller than you used to because of this uncertainty.
I think in the last 5 years, there's no short of volatility and wars and tariffs and any sort of macro news globally. But if you look at the overall sort of secondary market volume, usually the sort of pause, it could be a short term, but ultimately what is very important is the LPs and GPs look at how to manage the portfolio in a more holistic manner. So I think as long as there is a need for liquidity, I think you might see a dip in terms of volume in Q1 or Q2, but at the end of the day, if there's a target that they need to hit by the end of the year, they will need to come out to the market in the second half.
I think the biggest war that we've seen that has had impact in the secondary markets really the war on enterprise software, and that's had a huge impact on a lot of sellers delaying bringing software portfolios and private credit to market.
Huge.
That's actually a very valid point. I think we've seen sellers actually pulling tech-heavy GPs or tech-heavy funds away from the sale portfolio, right, just to get an optically better pricing, and they know that they're not going to get a very good pricing or even good bidders for that, right? And I think buyers in general are still relatively cautious in terms of the overall tech exposure that that they want to actually acquire, right, before even understanding what's the extent of the AI disruption risk to the tech companies in the portfolios.
So we're just to follow on that. We're seeing high quality tech managers that were trading at 95 to par in Q4 and Q1, trading down by 15 points, if there's a bid at all in those cases.
But what about the buy universe for that type of deals? Like, is it a big pull?
It was. It's quite a bit smaller now.
Yeah. Yeah. Well, moving on to the next section of this panel discussion. So we're gonna go into LP-led and GP-led separately. We're gonna explore what the nature of the deals look like, what price they're being traded at. So in the first section, we're gonna talk about LP-led first. I wanted to go to Ben first. I wanted to ask about the type of I wanted to ask about the scenario where LPs are selling Asian fund portfolios, because we have a lot of Asian GPs in this room. How much of that scenario is motivated by LPs wanting to get rid of their China exposure?
So I think, speaking with our clients, the China book of APAC-based LPs has essentially been in a holding pattern for 2-3 years now. There's a process that was just happening with China assets that, as far as I'm aware, we were not advising on it, but I believe it's been put on hold. That is a process that every one of our clients was calling us, asking us to keep them updated to see what kind of pricing the market would bear. And the initial indications were that pricing was ahead of expectations, and that had that deal gone forward, it likely would have led to quite a bit more selling of these assets. People aren't expecting 90 cents or maybe even 80 cents in these situations, but the pricing that we saw was enough for them to say, look, if that closes, we're willing to step in and potentially become a seller in that type of market. Otherwise, it's just a sort of a no bid environment.
So are these sellers motivated by the low DPI issues or the geopolitical concerns, or is it just like overall portfolio management?
I think it's more, well, first of all, DPI is only generated by a sale of the underlying assets, right? So you're moving something off your books, you're probably taking a loss in that case. You're not really generating DPI, at least not in a positive sense. You're generating negative DPI. So there's a motivation to seek liquidity. I don't see any sellers talking about geopolitics. I mean, I've lived in the region for 30 years. Geopolitics has been an overarching theme for that entire time. It seems to kind of ebb and flow, but it's nothing new. It's certainly not what most financially motivated investors think about. I do think it's more towards sort of cleaning up their books. These were huge amounts of dollars. I think the previous panel mentioned it's 80% of Asian NAV. So if you made commitments to an Asia book, you absolutely have at least half that book in China. And so those were commitments made 2012 through 2021. And I think it's more of a cleanup exercise in those cases and wanting to redeploy into other more productive parts of the market.
John, do you want to add?
No, I'll pass on this one.
Yeah. So I think we do see quite a bit of China out there for say China content or the interest to actually sell. But I think even for us, I think we're pretty cautious, right? I think when it comes to China content, I think the observation is that the geopolitics is maybe one of the contributory factors for maybe some sellers, right? That are more US centric or so. But I think generally it's always performance, basically. And you get to a point where you want to just bite the bullet, take the loss, and redeploy the capital somewhere else, right? Get that liquidity and redeploy. Because in secondaries, it's a very clear game. I think exit certainty is really everything, right? And when you have no certainty of exits in a current environment, then you might as well just try to manufacture that in the secondary market, get that liquidity, redeploy to markets where there's a lot more certainty in terms of exit outcomes.
Thank you. I think we've talked enough about geopolitics. I wanted to take a step back to talk about Asian LP-led market. I think there's this common perception out in the market that Asian funds, whether it's growth funds in Asia or venture funds in Asia, that they're being traded at a wider discount compared to U.S. funds, compared to European funds. Is that a fact or is that a myth?
Fact.
Yeah.
Why is that?
So I think factually, if you purely look at from a pricing perspective, I think it's true that Asian funds do trade at a wider discount than funds in the US and Europe. But I think it's quite important to understand that the concept of discount is actually a very subjective sort of measure, because at the end of the day, the pricing is dependent on the underlying assets and also depend on how the GP is valuing the underlying assets. So if we look at across Asia, apart from buyout funds who do quarterly valuation on their assets based on public comps, transaction comps, a big part of the market are in VC and growth. These assets, in most cases, are actually marked at last round valuation. So if we look at the market in general, the peak of private fundraising was done in 2022. So as a result of that, you would see a lot of these assets were actually highly marked at a very stale valuation. So the fact that these funds are traded at a larger discount could be the case that it's a reflection of valuation multiple sort of closely tied to where the public market is trading right now. But it doesn't necessarily mean that the quality of the asset is worse off in those transactions.
The other thing to add to that is that the secondary market is about supply of sellers and assets on the sell side and the buy side capital as well. So if you have most global groups like a Collar, et cetera, Partners Group that have got a up to 10% allocation to Asia for their secondary fund, that's a tough battle at the IC when you bring an Asia portfolio to IC for a decision. I think personally that the buy side formation for these assets is going to be one of the most important metrics to track going forward. We see not only groups like those on this panel here, but even LP buyers who say, I know those assets are of high quality. I know they are undervalued by the market. They forming either an SMA with a manager to say, let's go after those assets, or maybe doing something creative themselves. I think it's going to start more locally with groups that truly understand the value of these assets and understand the markets they're operating in, rather than some IC in New York or London making a decision out of, again, a global pool of capital that has kind of an earmark up to 10% allocation.
And we just do very opportunistically the LP-led, and I'm going to talk more about the GP-led, but the demand and supply side is a critical one. Back to the point I was making earlier, we see some of the terms we can have on the GP-led, on the portfolio, are very different from the one you can have in the US and in Europe for this precise reason, this imbalance between demand and supply on the capital side.
I wanted to ask John, because you said you also look at some funds in emerging markets like LATAM or Africa as well. How do you see the pricing or the discounts compared to between emerging market funds like LATAM, Africa versus Asia?
Yeah, so similar to what Ben said, I mean, it really comes down to supply and demand. If you think there are very few buyers for Asian assets, there are much less in those geographies.
So yeah, also just to clarify, if you look at the numbers, yes, there is a risk premium associated to Asia content on the secondary market. But if you look at the strategies, top quality buyout managers, right? Typically some of the blue chip pan Asian platforms actually still fetch a pretty strong pricing. I think you get to the 90s, right? You get to normally par in developed markets. But when you look at a much bigger exposure to maybe India and China, right, for diversified Asia content, that's where you get a little bit more of a dispersion. And if it's pure single country focus, right, then I think that's where the bid ask spread really widens a lot, right? And to Karen's point about VC growth, there are a lot of outdated valuations, right? People or buyers do have concerns in terms of exit outcomes. Is there actually is the buyer universe narrow, or is it actually, are there a whole suite of potential buyers for those assets? So these are all real considerations, right? And when you think about it, if most of the secondary players out there have run global programs and up to 10% in Asia, it's always a bit of a relative value discussion. Do you want to buy Asia content, right, with less predictable outcomes, or would you rather buy something that's in the developed markets?
Thank you. Moving on to the GP-led market. If you think about the GP-led market globally, it's been dominated by CV, and it's the same in Asia as well. So I guess my question is, I'm just seeing one question popping up about GP-led secondaries. Okay, let's take this now. Why is the Asian market less receptive to GP-led secondaries than the US?
I think my short answer is education. Just it's a new technology for GPs to use. It's been around for a while. In the kind of 2000s, there were these zombie funds, and sort of the cleanup exercise essentially amounted to a CV or a continuation vehicle. What we're experiencing today really began during COVID. So 5 years ago, essentially, when at least our group began working with our GPs in the US to provide liquidity back to their LPs at that moment in time. But what GPs realized was this is really more of an asset management, portfolio management type of tool they can use to work with assets longer, to hang on to their trophy assets for longer. In most cases, I mean, the 10-year fund is a human invention, and it can be broken like anything else. And so when the GP says, well, I have an asset that's really hitting its stride, compounding at 30, 40%, but we have the 10-year deadline, and now I'm going to go sell it to my competitor. So all my hard work has gone into that, and I'll hand it over to my competitor. I think GPs are more in the business of staying with assets of really high quality, and that's where they want to be. So I think we'll see a lot more of this, not less. We did almost 50 of these transactions last year. 35 of them were in the US. None of them were in Asia. And so as we go around speaking with GPs, I think there is a learning curve. There's a understanding of how these transactions, first of all, actually work, what types of transactions work and don't work. The previous panel talked a lot about this, about asset quality, about GP alignment, and of course about the exit. I think those are the three key things. But I think it's a learning process. As we speak with GPs across this region and they begin to understand how these are managed and the right way to handle these processes, I think we'll see a whole lot more and not less of these.
I think we should not forget that this market is still relatively young. We've been doing that for 18 years. To be frank, we were way too early at the beginning. And we saw, if I think about the first direct secondaries that we did was probably 11, 12 years ago. And it was really seen as a failure for the GP, right? So now, progressively, it was seen as, okay, one option, and now it's one solution. So which is very different. So GP wants to either create DPI ahead of the next fundraising or create a different story. So, exactly in line, I think it's a matter of education, it's a matter of time. We tend to compare too much Asia with Europe and the US that are way older in terms of markets, and there is maturity everywhere. And we are really going to this phase. So that's personally, we are quite excited about what lies ahead.
I wanted to ask about the pipeline that you've seen recently. I think historically I have reported on quite a few continuation funds in Asia in the past couple of years. Are we seeing other types of GP-led secondaries processes like tender offer or other types recently? Karen?
I think in terms of GP-led, in recent sort of 12 months, I would say that CV probably is the dominant strategy. We saw less tender processes. I think that goes with, I think we talk about demand and supply for secondary capital in Asia for quite a bit. I think that is also driven, that has also driven what transactions can be done versus what cannot. If you think about the GP-led transactions that were completed in the last 24 months, these are transactions where it's high quality assets, there's high conviction from the GP, strong GP alignment of interest, and there's, to be very honest, very sort of everyone is chasing against the sort of, they want to do, if they need to do 1 or 2 deals per year in a global platform, or if you have limited capital, you would want to do the best transaction in the market. So as a result of that, there's a lot of background conversation around all sorts of different types of CVs in the market. But at the end of the day, what is very important is that whether or not you can you can get a buyer to complete the transaction, whether you can get LPAC approval to do the transaction. So as a result of that, you saw sort of the quality of the CVs in the past 12 months sort of increase quite a bit compared to, which is very different compared to the transactions that were being completed 3 years ago.
For
Actually, one thing to add as well, I think what we are seeing more as well is that people are more open-minded about different pricing structure to solve for the pricing bid-ask spread. So you do see transactions that were done in a structured manner or with deferral as well.
Just to add as well, if you look at it, what we observe is that Asian GPs tend to like to, those that are actually open to doing CVs actually tend to favor constructing a portfolio with multi-assets rather than single assets. And I think that's really coming from the demand from buyers as well, right? People like quality assets, but people are conscious of the mixed exit environment in Asia, right? It's not always the same exit environment in each country, and you need to really think about diversification there to actually attract the number of buyers. Now, why are CVs so dominant compared to tender offers, right? If you look at it, there's just very little demand from the buy side to buy a country focus or to launch a tender offer for a country focused fund, because the exit outcomes, again, right? I talk about exit outcomes, is really quite unpredictable over there, right? It's typically very tired assets in a particular country where the GP has a difficulty in exiting those assets, and to think that there's suddenly going to be a hockey stick recovery with a very good visible exit outcomes within the next 2, 3, 4, 5 years, right? I think it's just, yeah, it takes a whole new level of conviction.
And please go ahead. When you assess Asia as a region, it's such a fragmented market, and I wanted to ask how you are assessing opportunities in different parts of Asia. How do you see, let's say, developed Asia, places like Australia, Japan, Korea versus emerging Asia like China, India, Southeast Asia?
So maybe just one quick follow-up on the CVs, and we've clearly these structures are complicated because it involves a lot of different parties. I agree with your comment on the portfolio. It's also because of the buyer side. But one thing that we see also developing is these direct portfolios, where we have 30 people in our team, we have people on the ground, so not everyone can do that, but it's a very good solution also for a number of funds that we see, that you need to understand why these people are doing CVs or looking for liquidity, right? So, but we see more and more of these in India, in China, funds who are preparing for the next fundraising, wanted to generate DPI. Instead of selling 100% of their asset, they sell 20% of 2 or 3 assets, send back DPI to the LPs, and prepare for the next fundraising. So it's really something that we are seeing developing. We are doing that a lot. It's an attractive, at least for us, part of the segment.
And on the different Asian markets?
Yeah, so on the different Asia market, it's quite important to have a Pan-Asian investment capability. Why? Because, and we've seen that over the last 15 years, a lot of cyclicality that we have, when some markets are closed, others are open. So if you can only operate in a limited number of geographies, it's difficult. And having this ability to be pan-regional is something very important. Now, between emerging Asia, China, India, or developed Asia, there is more stability clearly on the developed Asia. Even if you look at Japan, we don't do much Korea and Australia, so I'm going to let my other panelists to talk about it. But for Japan, the second market remains small for the moment because the liquidity is quite good, whether on the buyout side, whether on the IPO side. So it's a balance that you have to do. It's a pan geography that you need to have for your investors and to be able to make your own allocation depending on the time from one country to the other.
Karen, you closed a deal in Southeast Asia last year. How are you seeing opportunity in that market?
So I think for us, we are operating across Asia in general. I think for us, it's more about how everything in the market has a price, right? So at the end of the day, it's how you can price it and how comfortable you are with the exit environment. So if we compare sort of developed market versus developing market like China, Southeast Asia, or India in general, at the end of the day, it's a matter of whether you can pick and choose a portfolio of assets or assets that you see that there is exit viability and also potential, and whether you can price it correctly with the right sort of risk premium in mind in general. So in general, I think developed market, it's easier for people to understand because exit market tend to be much more stable. There are different exit routes such as IPO or M&A exit in general. When it comes to developing market, the trend is it still tends to be an IPO exit market. But we do see that there is a differentiation in terms of like asset sort of industry, which is actually quite an attractive environment, attractive opportunity to invest in right now.
So in Asia, we have seen a pickup in IPO activities, I think across Hong Kong market, India market. Does that help with closing CV transactions in any way, Ben?
I'll let somebody else comment on that on the buy side.
I think that's definitely helped in terms of our demand for CVs in emerging markets like in Greater China, right, where you're banking on a lot of Hong Kong IPOs or India as well. So yes, definitely right. I mean, once you have that exit visibility, the demand comes through and it's easier to syndicate. Yes.
But has anyone here on this stage been in a scenario where the GP was thinking about doing a continuation fund and then the Hong Kong market is just doing so well, they decided to shelve the CV plan, GP-led plan, and then just go ahead to do just an IPO?
Specifically in Asia, I don't have any specific example, but globally, GPs would normally do a dual track, right? I think they would try to go for IPO markets. They're trying to look at multiple tracks, basically, or try to look for a trade sale at the same time as well as a CV, right? I think ultimately the ultimate aim is to generate liquidity. And yes, sometimes when they find that it's the best option for their existing investors to actually pull the CV process because they're getting a very strong valuation from a strategic, then that's actually doing the right thing, is the right fiduciary duty for the existing LPs, right?
So Martin, I think most of us here talked about where they're spending time in. Karen just came back from Singapore just last week. Fred's been spending quite a bit of time in India. What are you seeing? Where's your deal pipeline coming from this year?
Yeah, so we are fortunately in a buyer's market where we can actually pick and choose, right? So I think every single week there's an LP portfolio out there for sale. Things that we find where we have pretty good conviction, I think we'll go for them. I think we're pretty selective. We are proactive in terms of high conviction markets, and for us it's still developed markets, right? And that's where we're pretty proactive in hunting for the fund interest that we like or the underlying assets that we like, and how we actually, and we actually leverage the primary relationships that we have. We got a pretty big primaries platform, and we harness these relationships to try and develop early access into assets where we've got pretty high conviction. When it comes to the emerging markets part of it, I think that's where we take a more opportunistic view. I think we've transacted on a few emerging markets pieces right in the past few years, but they tend to be part of a global portfolio.
So moving on to the next question, I in the past 3, 4, 5 years, I've tracked CV transactions in Asia quite extensively, and the common thread that I'm seeing is that for some of the bigger continuation funds, the discount is getting slightly smaller. And last year, I reported on one single asset continuation fund that was around the size of 500 million in Korea, and that I remember has really little or no discount. So I just wanted to ask our investors here. Are you seeing the same thing?
I think globally, single asset CVs are trading at 95 to par. And we see something similar here, although the data set is much, much smaller. So it's difficult to tell if it's a trend that you're talking about. But we think that generally speaking, single asset CVs trend towards par or maybe even a slight premium. Multi-asset is where you see the discount. And that really depends on asset quality, asset concentration.
Ultimately, it's asset quality, right? A good quality asset, sizable, with very predictable exit outcomes. I think it's always going to trade in the 90s to par, right? I mean, that the transaction that you talked about, I think everybody knows what it was. Very good quality asset, good GP, right? Done by one of our friends in the room as well. But then there's a long tail of mediocre assets that don't actually get done, right? Because they don't actually fetch the pricing that the GPs actually want. Right, and these are the things that don't get reported, right? What gets reported are the quality ones that get done, and definitely, I think quality comes at a price.
As Martin was saying, I mean, we are in a buyer's market, right? Clearly, and what is interesting, if anything, the trend is probably with some of the GP becoming more and more knowledgeable about it and making sure that there is more right selection of assets, which by nature will improve the quality and reduce the discount than anything else.
If a GP shelves an IPO, that's one thing, and it's a fairly quiet thing. If a GP goes through a CV process where they have exposed those assets to price discovery and let all their LPs and all their potential investors know how the market views those assets, and that fails, that's a much riskier prospect for the GP. So it's all about quality of assets going in and the story and the exit.
So moving on to the last section of this panel discussion, which is about the outlook. What would be your prediction for the rest of the year?
I think everyone's busy. We're just going to get busier, right?
So globally, Q1 is a very busy quarter for secondary transactions. It was our busiest at Evercore ever. For LP-led transactions in Q1, and so that's 13 years of data. Q1 26, busiest ever. Now, keep in mind, Q1 ended, I think, the day before the Iran war began. So we've got that behind us. Q2 generally is always a bit softer, and then it's kind of Q3, Q4 where things pick up, and LPs in particular have to kind of meet whatever goals they set for themselves at the beginning of the year. They pick things back up typically around August, September. So, in terms of LP activity, I was telling you earlier, Pimfa, I did a roadshow last week, met with 30 LPs, and with two notable exceptions, every one of those 30 groups is either actively pursuing some kind of sale process or thinking about it. So I feel like we've got a very busy year ahead of us.
On our side, I anticipate, there are two big trends in my view. One, clearly on the deal side, deal flow, which will continue, if not potentially accelerate a little bit in China, now that we have even a bit more visibility. We don't have time to talk about the split between AI and non-AI, but there are interesting things. But the second interesting one, which we have not talked too much, is more and more of, in my view, of international investors will start to come back looking more about Asia. Asia has been put aside for quite a while. You start to see some large funds raising large pool of money in Asia and beating their targets, which is actually an interesting sign. So you have first the public market, then you start to have the private market coming in on the fundraising side, and naturally there will be more and more interest coming in the region.
My gut feel is that I think we saw a very strong year on the LP-led side from APAC sellers. There were also a lot of first-time sellers.
Sorry, are they Taiwanese insurers?
I think all sorts of institutional sellers. So I think that sort of like opened the gate for some of the others institutions who have been deploying in the market for quite some years now to explore selling in the market as well. And you also have the return of some of these large scale APAC LPs who haven't been selling in the market in the last 2 years. So I think LP-led market definitely will be a very strong year. On the GP-led side, last year it was very busy in the second half. So my prediction is that it's depending on the market situation, and also I think it's a lot driven by sort of market sentiment on the public market as well. I do expect there could be more GP-led transactions coming into the market on the back of that.
Yeah, on on the tail end side, it's been incredibly busy. Just the cliff of funds that's coming to, 15, 20 years, that continues to grow every single day. So we continue to see a lot of deal flow from people cleaning up. It's great. There are many first-time sellers, and the second and third time they sell, they trim off things that they don't care about that much. And we're starting to spend time with GPs who have 15 to 20-year-old funds, and they have a couple assets left. And potentially we're looking at some CVs at the tail end, which which is probably more developed in the U.S. market.
Yeah, so I think Karen's point on the first-time participation of some of the institutions in the region for the LP market, I think it's really spot on, right? I think it's and that's going to be probably a structural form of deal flow going forward. I think you're going to see other institutions taking encouragement from that, and then you're going to have a repeat participation from these sellers in terms of actively managing the portfolio. On the GP-led side of things, like I mentioned earlier, just given the overall difficult M&A activity around, right, we believe that there's going to be a lot more GP-led situations in the market. And what's also really encouraging is since the time that we did one of the first GP-led transactions 5 years ago in the region, I think we've seen an overall improvement in the quality of assets that have been put up for continuation by the GPs.
Thank you. I guess that's a good way to wrap up our panel discussion today. Thank you everyone for tuning in. Thank you our speakers.
Thank you.